I think what's going to start to happen if we get bounces is the reverse of what we've seen over the past 10 or 11 years. The past 10 years, it was buy on the dips. And I think what we might see from jittery investors is sell on the bumps. These sharp moves, 10% down, 5, 6, 7, 8% down a day, is really trying investors' nerves. The worst fears are setting in. The ghosts of 2008 are resurfacing for many people. And I think we're going to see the rally limited to some extent by people taking whatever they can off the table.
Yeah, you mentioned the ghosts of 2008, but trading strategies have changed since 2008, right? We have the rise and emergence of passive investing, also algorithmic trading as well. When you see something like the VIX, the volatility index, close at its highest level ever on record yesterday, how do you factor in what those types of strategies are doing to the market and these major moves we're seeing?
Well, I think in some ways they're exacerbating it. I think it's out of the control of the individual investor once the computers take over. And I think that's some of why we've had back-to-back 8 and 10% down and then 8 or 10% up on back-to-back days, because that really makes little sense. But look, the underlying fundamentals are concerning. I'm on the trip in today, and Washington, D.C. is a ghost town. And when I see no one on the roads and there's going to be no one in restaurants and bars and gyms, it's going to really continue to threaten some of the weakness in the oil patch that we've seen. Demand for oil is going to plunge. The people that lend to these sectors that are struggling, whether it's leisure or energy, they're going to be impacted. We can't pretend that people not taking cruises, air flights, hotels, theme parks, everything related to those is shut down. We can't pretend to think that those supporting those activities aren't going to feel a residual effect. So there's some legitimate reason for the stocks to pull back. Absolutely. The question is, what about valuation? And right now, we think we're getting pretty close to what might be nearer to the bottom than the market's emotional reaction is indicating.
I'm glad you just brought that up, because the question I have for you is this, how much of this, the reaction we're seeing in the market, is the crisis itself versus all of the uncertainty around that crisis? And I ask that in part because I wonder how much is actually priced into the markets here, especially since we don't have the most up-to-date data points, and we don't exactly know how this is going to play out for earnings for those different equities and different industries over the coming months.
Well, the way stock prices are being suppressed across the board tells me it is what you alluded to earlier. It is more of a program trade. We're starting, hopefully, and we're going to start to see more of stock selection take over, that good companies that aren't affected by this, companies in the communication services and technology, might actually benefit in an odd way from the relocation of society or the reallocation of resources and the changes in trends. And yet we've seen stocks being brought down across the board. So when I look at a Microsoft or Apple, I just wonder, why are they being dragged down? Maybe they were a little frothy at the peak, but at this point, if we continue to be 6 feet away from each other's society, how do communication services and smart tech companies not benefit from that trend?